Ever wondered how businesses really talk? Not just in meetings, but how they talk about their success or how they talk to investors? Well, it's not some kind of magic. It's actually a universal language. And here's the kicker. It's less about being a math whiz and way more about telling a good story. So let's dive right in and learn how to speak it.
So that brings up a big question, right? How does a business take all the day-to-day stuff, every single sale, every purchase, every payment, and turn it into a story that actually makes sense? You know, a story that can tell you about its health, where it's struggling, and where it's headed. Well, the answer is accounting. That's it. Think of accounting as the official language of business. It's the translator that takes all that complicated activity and turns it into a clear, standardized story. The cool part, once you learn this language, you can understand the story of any business out there.
Okay, so every language has its rules, right? It's grammar. And in the language of business, it all boils down to one simple but incredibly powerful rule. This one formula is the foundation for, well, everything.
First up, let's talk about assets. This is basically all the good stuff a business owns. We're talking about the economic resources that have value. Think cash sitting in the bank, the computers everyone's using, or even the building itself.
Next, we have liabilities. This is kind of the other side of the coin. It's everything that business owes to other people or other companies. The most common example, a loan from the bank. But it could also be money owed to suppliers.
And finally, there's equity. This one can sound a little abstract, but it's really just the owner's piece of the pie. Imagine this. If the business sold off all of its assets and used that money to pay off all of its liabilities, whatever is left over, that's the owner's equity. It's their stake in the company.
And here it is, the golden rule I was talking about. Assets must always equal liabilities plus equity. Every single transaction has to keep this equation in balance. No exceptions. It's the ultimate double check to make sure everything is accounted for. And what's so brilliant about this is it gives you a super quick health check on a company. You know, a business funded mostly by liabilities, by debt, is usually seen as way riskier than one funded by the owner's equity. See? Just like that, you get instant insight.
Okay, so if that equation is the grammar, how do we actually, write the story? Well, we follow a specific process. You could even think of it as the plot. This is what's known as the financial accounting cycle, and it's there to make sure the story gets told consistently and in the right order.
This image here lays out the entire journey, all 9 steps. Now, I know what you're thinking. That looks like a lot. But don't worry, don't get overwhelmed. For today, we're just going to focus on the first few, really crucial steps that get the whole ball rolling. And to do those steps, we need to learn the basic actions, the verbs of this language.
All right, deep breath. We're about to tackle debits and credits. I know. These 2 words can sound super intimidating. But I promise you, they are way, way simpler than they seem. They're just the tools we use, the mechanics, to keep that golden equation perfectly balanced.
So let's strip this all the way back to basics. For just a second, forget everything you think you know about good or bad, plus or minus. At its absolute core, a debit is just an entry on the left side of an account, and a credit, it's just an entry on the right side. That's it. Seriously. Left side, right side. Let's start there.
Okay, here's the crucial part. Whether a debit or a credit means an increase or a decrease totally depends on the type of account we're talking about. Now, this table might look a little busy at first, but just follow along with me on that first line. To increase an asset, like cash, you use a debit, an entry on the left. But now look at the very next line. To increase a liability, like a loan, you use a credit, an entry on the right. So just think of them as directional tools.
Let's make this real with a solid example. Say someone starts a business with $95,000 in cash. Okay, so the business's cash, which is an asset, goes up. So we debit it for $95,000. At the exact same time, the owner's stake in the business, their capital, which is equity, also goes up. And an increase to equity, that's a credit. Look at that. The debit equals the credit. Our equation is perfectly, beautifully in balance.
All right, now let's see how this all clicks together in a real system. We're going to follow a single transaction from the moment it happens to the moment it's officially on the books.
So this process really has 2 main parts. First, every single thing that happens financially is recorded in order in something called the journal. The best way to think of it is as the business's daily diary. Then, all that information from the diary gets sorted and organized into the ledger. The ledger is more like a big filing cabinet with a separate folder for each account, one for cash, one for loans, and so on.
And here is step 1 right in front of you. On June 1st, Mr. Daniel puts $45,000 of his own cash into his new business. You can see it all laid out, the date, the accounts that were affected, and a perfectly balanced debit and credit. The cash account, an asset, gets debited to show it increased, and Mr. Daniel's capital account, his equity, gets credited, also showing an increase.
Now for step 2. That $45,000 debit to cash that we just put in the journal, our diary, now gets posted. That just means it's transferred over to the right file in our filing cabinet, the cash account in the ledger. And you can see it right there on the debit or left side, which brings the total cash balance up to $45,000. Every single entry from the journal gets sorted out just like this. So, why are we doing all of this? What's the point of all this careful recording and sorting? Well, the ultimate goal here is to produce the final chapters of our financial story. These are the big reports that summarize everything that's happened.
And these reports are called the financial statements. The balance sheet is like a snapshot in time. It shows you what the business owns and what it owes on one specific day. Remember our golden rule? That's a balance sheet. Then you have the income statement, which tells you if the business actually made a profit. The other statements track changes in the owner's stake and the real, actual movement of cash. Each one tells a different but equally critical part of the whole story.
You see, learning bookkeeping isn't just about crunching numbers. It's about empowerment. It gives you the power to read, to understand, and to write the financial story of any business, maybe even your own. So now that you're starting to learn the language, the only question left is, what story is your business going to tell?